Today, we're going to dive deeper into the price chart. And the area we're going to focus on today so much will be these bar-like structures, which seems to make no meaning to someone seeing them for the first time, yet are very crucial and important when it comes to understanding the behaviors of traders in the financial markets. The features we're going to look at is what we call the candlesticks. Now, the candlesticks, as we saw in the previous video that I shared with you, are a representation of traders' behavior in the market. In our last video, we related every candlestick we saw on the chart to a time frame. And we said that irrespective of the time frame you choose on the chart, each of the candlesticks you will see displayed will be representing the activities of traders within that particular time frame. And I gave an example that if your time frame here is showing 1 hour, all the candlesticks that are going to be shown on the chart will be representing activities of traders within 1 hour each. So all the candlesticks you see on the chart would have taken 1 hour to completely build up. Now, if you change it to 4 hours, all the candlesticks you're going to see displayed on the chart will be representing 4 hours each, meaning it will be showing the behaviors of traders within each 4 hours that passes by. Now, a candlestick has two parts, the wick and the body. And the body of each candle is divided into two subparts, an open and then a close. And the wicks, which are sometimes referred to as the shadow, are also of two parts. There is the upper wick or upper shadow, and then the lower wick or the lower shadow. The upper wick is an extension from the body of the candle from the upper side, and then the lower wick is an extension from the body of the candle on the lower end. And both of the wicks are a representation of price fluctuation during a given trading session. The end of the upper wick is what we call the high, which literally represents the highest price registered in the course of that particular trading session as represented by that candlestick. And the lower end of the lower wick is what we call the low, which is a representation of the lowest price registered in the course of that trading session as represented by that particular candlestick. And the body is a representation of the price difference between the opening price in that particular trading session and the closing price in that particular trading session. And there are two types of candle that are always shown on the chart: the red candle and the green candle. These are the default colors that we most often find on the chart. Now, the red candle is a representation of a trading session that were dominated by the sellers. And the green candle is a candle that represents a trading session which were dominated by the buyers. In simple terms, the green candle represents the buyers and the red candle represents the sellers. Now, for a green candle, we have the opening at the lower part and then the close on top. And for a red candle, we have the opening on top and a close at the bottom. Now, you can as well, in a simple term, define a green candle as being a candle in which the closing price is above the opening price or is higher than the opening price. Then, for a red candle, you can define it as a candle in which the closing price is below the opening price. Now, having known what a green candle is and what a red candle is, let's go back to the chart and try to relate. We are going to begin with the green candle. Looking at this first green candle, if you were to locate the open and the close, definitely This would be our open, and this would be our close, right? On this candle, this would be our open, and this would be our close. And looking at these two consecutive candles, you will tell that the price has been progressively increasing. Now let's go to these other two series of the red candle. For the red candle, this would be the open, right? And then this would be the close, because we said the close of the red candle is always below the open. Then on the next one, this would be our open, and this would be our close, right? And looking at these two consecutive red candles, you will tell that the price has been moving down. Let's go to this other part where we have a mixture of green and red. For the green candle, this would be our open, and this would be our close, right? And for the next candle, this would be our open, and this would be our close, right? You can go ahead and relate with all the other candles you see on the chart. And from the look of things, you will appreciate the fact that the price of this financial instrument has been moving up and down, rising and falling over time. And this is what we trade in the financial market, and it is what we call volatility. So volatility is what makes us make the money. With that volatility, it will be very difficult for us to profit from the financial markets in any way, because those of us who are involved in crypto trading and more so in the sports market, our aim is to buy when the market price is low and then sell once the market price rises a little, so that the difference can be our profit. So without the volatility, we wouldn't be in position to make any profit at all. So thanks to the volatility. So in summary, this is what the candlestick is all about, and this is what the price chart is all about. I hope you learned something. See you in my next video.